On January 30th, 2026, at 12:46 a.m., CME Clearing publishes the COMEX Metals Delivery Report for the January 29th business day. The silver vault ledger shows 107,674,551.930 ounces classified as registered, the category that can be delivered against futures. At the same day's COMEX settlement of $113,111 per ounce, that is exactly 12,179,176,243.35 in deliverable silver sitting behind the world's benchmark paper price. And the number looks large until you ask one question that almost nobody asks in public. What if deliverable is not the same thing as liquid? And the next breakout forces that difference into the open. If you hold silver, trade silver, or simply live inside an economy that prices everything off collateral and confidence, this changes everything. The data shows that every monetary system breaks the same way. It does not break first in headlines, and it does not break first in elections. It breaks first in plumbing, in settlement, and in the quiet places where obligations are rolled, swapped, rehypothecated, and assumed to be good enough until they are not. This unfolds in 4 stages. Stage 1 is paper expansion, when leverage grows faster than supply because synthetic exposure is cheaper than physical custody. Stage 2 is inventory compression, when deliverable stock shrinks relative to outstanding promises, even if total stock still appears ample on the surface. Stage 3 is liquidity inversion, when the cost to source the real thing rises, spreads widen, and the market begins to pay for certainty instead of exposure. Stage 4 is forced resolution, when rules are changed, margins are raised, settlement terms are tightened, and the system chooses who gets metal and who gets cash. Throughout the last 100 years, every reserve asset, every currency regime, and every exchange-based collateral system follows the same sequence. The timeline varies, but the order never changes. This isn't prediction, this is pattern recognition from a century of data, and the pattern is visible right now inside COMEX Silver. The modern silver market is not a single market. It is an ecosystem of futures, options, ETFs, unallocated accounts, retail bars, industrial offtake, and vault programs stitched together by one assumption. The assumption is that promises can be rolled indefinitely because deliverability will always be there. The moment that assumption becomes expensive, the entire structure reprices. As of January 23, 2026, silver trades above $100 per ounce in a speculative surge that rewrites decades of price history. And when price moves that far, that fast, it is never just a chart story. It is a collateral story. It is a margin story. It is a settlement story. COMEX inventories are reported in categories, and the category that matters in a stress event is registered. Registered is not all silver, and it is not all eligible silver. Registered is the slice that is warranted and positioned for delivery against futures, the metal that is supposed to close the loop between paper claims and physical bars. When the market is calm, that distinction feels academic. When the market is stressed, that distinction becomes the difference between a functioning exchange and a cash-settled narrative. Now look at the ledger the way a risk manager looks at it. The registered pile is $12.179 billion at 113.111 per ounce, and it sounds like a fortress. But the fortress is only meaningful relative to the obligations that can arrive at the gate. The hidden crisis is not that there is no silver. The hidden crisis is that deliverable silver is not designed to absorb a stampede. To understand why, you need to see how this ends when a system tries to cap a price using promises. History records the same movie 3 times, with different actors. In the first case, the reserve asset is gold. The institution is a coalition of central banks. On November 1, 1961, the London Gold Pool is formed to defend a fixed price of $35 per ounce under Bretton Woods. The mission is simple on paper and impossible in practice. Supply is finite, but credit is not, and when credit is expanding, paper claims on the reserve asset grow faster than the reserve asset itself. By March 1968, the arrangement collapses under the weight of demand. and London's gold market is shut down in emergency measures. The system tries to preserve the official price, but the market begins to price risk instead of policy. The lesson is brutal and consistent. When a fixed price promise meets a rising scarcity premium, the promise does not win. The second case is silver itself, and it is not ancient history. It is the template that every modern exchange studies, even if it rarely admits it. In 1979, silver begins a vertical move that looks unstoppable. By January 18, 1980, spot silver hits $49.45 per ounce, and COMEX silver futures print an intraday high of $50.35. The Hunt brothers are estimated to be holding over 100 million ounces and massive futures exposure, and the market discovers what concentration looks like when it collides with leverage. On January 7, 1980, COMEX adopts Silver Rule 7, restricting leverage and changing the terms of participation. This is not a moral judgment, and it is not a debate. It is stage 4. It is forced resolution. The result is the kind of cascade that only leverage can create. By March 27, 1980, Silver Thursday arrives, prices collapse, margin calls hit, and the system survives by changing the rules and choosing stability over free market settlement. The same pattern, same stages, same outcome. The timeline varied, but the sequence never changed. The third case is modern, and it is about logistics, not conspiracy. In March 2020, precious metals markets experience dislocation as refining and transport bottlenecks collide with futures settlement mechanics. Spreads widen between New York futures and physical benchmarks, and the market learns again that price is not a number on a screen. Price is the cost of immediate, certain delivery. When the pipes narrow, the market pays for certainty, and paper instruments trade like promises under stress. Three systems, nearly 60 years of monetary evolution. Identical four-stage cycle. And now, the present-day setup is visible in COMEX silver, not as theory, but as numbers with dates attached to them. Start with the reality of inventories. COMEX silver inventories are reported around 418 million ounces as of late January 2026, a level described as the lowest since March 2025. That sounds like abundance until you split it into categories and apply the settlement lens. Most of that inventory is not registered. Registered is the ready-to-deliver bucket, and as of the January 29, 2026 report date, registered stands at 107,674,551.930 ounces. At $113.111 per ounce, registered equals 12,179,176,243.35. That is the maximum visible deliverable liquidity the exchange can point to without moving metal from other categories. Now set that against the behavioral truth of stress events. When price moves violently, participants do not ask, "How much exists?" They ask, "How much can I get right now without forcing the system to bend?" That is stage 3, liquidity inversion. And liquidity inversion is never announced. It is felt. It is felt in spreads, in lease rates, in the willingness of metal to move, and in the way institutions shift from exposure to possession. It is also felt in margins. On December 29, 2025, a CME margin increase hits silver futures, raising the capital required to hold risk, and silver sells off sharply intraday. Margin is not a footnote. Margin is the steering wheel. When margins rise, leverage is reduced by force, and weak hands sell first. But the deeper effect is quieter. Higher margin also signals that the exchange is preparing for volatility, because volatility is how settlement stress enters the system. Right now, today, as of January 31, 2026, the Federal Reserve's balance sheet still sits at $6.638790 trillion in total factors supplying reserve funds. That is the background condition. Abundant base liquidity in the system, even after years of tightening rhetoric. Abundant base liquidity does not prevent scarcity in specific assets. It amplifies it, because liquidity chases finite things. And as liquidity chases finite things, narratives concentrate. The silver narrative is no longer a niche story. It is retail demand, industrial demand, and institutional positioning colliding at the same time. CME Group announces a new 100-ounce silver futures contract effective February 9, 2026, explicitly to meet record retail demand. That is not a marketing move in a vacuum. It is an adaptation to a market that is pushing pressure down the chain towards smaller units and immediate accessibility. Meanwhile, capital flows do what capital flows always do in Stage 2. They crowd into vehicles that promise exposure with simplicity. BlackRock manages approximately $14.04 trillion in assets as of December 31, 2025, and its platform remains a central artery of modern financial allocation. When allocation becomes crowded, the system becomes fragile, because crowded allocation assumes liquidity that can vanish in a single session. Even index mechanics can become a destabilizer. In January 2026, a major commodity index rebalance is expected to push billions of dollars of selling through silver futures over a narrow window. That is a structural flow, not an opinion. And structural flows can stress a market even when the underlying thesis is bullish. Now place all of this into the 4 stages and the picture sharpens. Paper expansion came first, and it lasted for decades. Inventories then compress relative to promises because the world learns to trade exposure instead of handling metal. The market is now flirting with liquidity inversion, where availability becomes the price driver. And when liquidity inversion hardens, forced resolution arrives. Forced resolution is not collapse. Forced resolution is the system choosing survival rules. This is where the COMEX $12.179 billion deliverable headline becomes dangerously misleading. Deliverability is not a guarantee of smooth delivery. Deliverability is a classification, and classifications can be reclassified, incentivized, or effectively rationed when stress appears. The hidden liquidity crisis is not that COMEX cannot deliver at all. The hidden liquidity crisis is that COMEX is not built to deliver at scale if too many participants demand it at once. In normal times, most contracts are rolled. In stress, a minority chooses delivery, and that minority can still be too large. The arithmetic of a run is unforgiving. It does not require everyone to act, only enough actors with enough size. And silver is uniquely vulnerable because it sits at the intersection of investment emotion and industrial necessity. When industrial users need material, they cannot settle in cash and pretend the factory runs. That is why silver stress is never just a trade. It is a supply chain event. If you are in your 20s or 30s, this affects you through inflation persistence, wage purchasing power, and the real cost of energy transition infrastructure that consumes silver in volume. If you are in your 40s or 50s, this affects you through portfolio correlation, because risk assets and policy reactions begin to move as one when collateral stress rises. If you are near retirement, this affects you because drawdown risk is not about average returns. It is about whether liquidity exists in the week you need it. Some will say this time is different because silver is higher, because inventories are reported, because the system is more sophisticated, and because cash settlement is always an option. The pattern confirms why that argument fails. Sophistication does not remove constraints. It hides them until they matter. Cash settlement is not neutral. Cash settlement is an admission that the system is prioritizing continuity over the original promise. And when an exchange leans on continuity tools, it sends a message to every participant watching closely. The message is that the metal is more valuable than the contract language. The market already prices this in subtle ways. It prices it in term structure, in volatility, and in the premium paid for immediate verifiable bars. That is the real meaning of a rally that runs beyond fundamentals. It is not only speculation, it is a migration from trust to possession. The cycle is absolute, and the present-day data points map onto Stage 3 with unnerving clarity. Watch what happens next over the coming 12 to 24 months, because Stage 3 does not last forever. It resolves into Stage 4. First warning sign: a persistent drawdown in registered inventories even when price is rising. If registered falls while price rises, it indicates that metal is being removed from the deliverable pool faster than it is being replenished. Second warning sign: repeated margin adjustments and tighter risk controls at the exchange level. Margin hikes are not random, They are responses to volatility, and volatility is the surface symptom of settlement strain. Third warning sign: widening spreads between paper benchmarks and physical premiums in retail and wholesale channels. When physical premiums stay elevated even as futures fluctuate, the market is signaling scarcity of immediate deliverable units. These signs do not guarantee one dramatic day. They indicate a regime change, where silver stops behaving like a liquid financial asset and starts behaving like strategic inventory. In that regime, the next break is not merely a price break. It is a break in the assumptions that hold paper and physical together. The next 12 months are likely to be defined by episodic volatility, sudden air pockets after margin events, and sharp rebounds when physical buying returns. The next 24 months are likely to be defined by institutional adaptation. Contract specifications expand, alternative settlement pathways grow, and the market builds new pipes because the old pipes are not wide enough. That is what forced resolution looks like in modern finance. It is not a single collapse, but a series of rule-based adaptations that protect the exchange and rewrite the incentives. And the biggest psychological shift will be this: participants who once cared about price will begin to care about access. When access becomes the priority, the market stops offering cheap exposure. It offers expensive certainty. This is not fear. This is preparation based on historical precedent. And the precedent is consistent across gold, silver, and every collateral system built on layered promises. The COMEX report number, 12,179,176,243.35, is not a comfort. It is a measurement of the narrow bridge between paper and metal. Bridges do not fail when they are empty. They fail when everyone tries to cross at once. For retirement accounts, the takeaway is not buy this or sell that. The takeaway is that volatility in a monetary metal is rarely isolated. It transmits into rates expectations, policy responses, and risk appetite, because metals are where confidence and liquidity reveal themselves. For savings, the takeaway is that inflation is not only a CPI print. Inflation is the price of scarce inputs in a system saturated with claims. And for anyone exposed to markets through pensions, index funds, or passive allocation, the takeaway is that liquidity is an assumption until it becomes a fee. The data shows that when liquidity becomes a fee, markets reprice faster than narratives can catch up. The 4 stages are not a theory. They are the recurring mechanics of how systems behave under stress. Here is the core thesis in plain terms. COMEX just shows over $12.179 billion in registered silver that can be delivered. But the market is entering a phase where deliverable and liquid diverge. That divergence is the hidden liquidity crisis behind silver's next break, because the break will be measured not only in dollars per ounce, but in how the system handles concentrated demand for real metal. You have a choice. Understand the pattern and position your expectations accordingly, or ignore it and assume this time is different. But remember the historical record. This time is never different because the constraints are always physical, and the promises are always financial. If this analysis opened your eyes, subscribe now.